Welcome to the Deep Dive, where we take the latest financial transcripts and turn them into actionable insights for you.
Yeah.
Today, we are diving deep into MillerKnoll. That's ticker MLLKN. And they just had a critical Q2 earnings call that sent the stock, well, soaring, up over 8% after hours.
It was an electric reaction. I mean, especially when you think about where the stock has been.
It's been a huge laggard this past year.
Exactly. So our mission today is pretty simple. We're going to cut through that noise and figure out why the market loved this report so much. Because, it wasn't some massive revenue beat.
Right.
It was about forward momentum. So we need to pull out the real strategic narrative here, focusing on that accelerating return to office trend and their costly but ambitious retail plan.
Okay, so let's unpack it. Let's start with the raw numbers.
Let's do it.
On paper, it was a clean beat. Adjusted diluted EPS came in at 43 cents. That just kicked past the 42-cent consensus.
Barely, but a beat is a beat.
And revenue landed at $955.2 million, which was also ahead of the street's $944 million estimate. So solid.
Solid, but not jump 8% spectacular.
No.
And that is the essential paradox here, because if you just looked at the top line comparison, reported revenue was actually down 1.6% year over year.
Down.
A minor dip, sure, from 970 down to 955 million. But the stock reaction tells you the market just completely ignored that sales decline.
Yeah.
And the reason is the single most important number in this entire report, orders.
So the leading indicator wins the day.
It absolutely did. Total orders for the quarter grew to 972.5 million.
Okay.
That's a robust 5.5% increase year over year, 4.5% if you look at it organically.
And here's the kicker.
Yeah.
Here's the core insight. Orders exceeded sales by over $17 million.
And that divergence is what convinced the market that demand has bottomed out and is now, firmly accelerating across all three of MillerKnoll's segments. You're seeing future revenue solidify right now.
And the company's narrative is that this is all being driven by the return to office trend finally hitting its stride. They used some really strong language on the call saying it's really taken off.
They absolutely did. And the data from the contract segment, it really backs that up. You can see how office upgrades and refreshes they're driving the whole pipeline.
So what did the North American contract orders look like?
They saw growth of 4.8% from the prior year. Now, the corresponding sales were down 3.1% year over year, but we have to provide some context for that.
Okay, let's clarify that. Because sales down, orders up. How does that work?
Right. It's all about something they called pull-ahead activity from the previous quarter.
Okay.
So basically, in Q1, MillerKnoll saw this huge acceleration in customer requests. We're talking about $55 to $60 million worth, where revenue that should have hit in Q2 actually landed in Q1.
So it's a timing issue.
It's purely a timing issue. Q2 sales look soft in isolation, but if you smooth it out over the first half of the fiscal year, North America contract sales are actually up 4.1%. The growth is real.
That distinction is so important. Once you normalize for that noise, you see the momentum. What about internationally? Was it the same story?
The international picture was even cleaner, actually. International contract orders were up 6.6%, 3.4% organically. And it wasn't just one region. They cited strength in Europe, the UK, and crucially in China and India.
And who's driving these big office overhauls? Is it tech companies, finance?
They emphasize stability. It's coming from resilient sectors.
Right.
Healthcare, for instance, where orders are up 5% year to date. Also professional services, energy, legal firms, the kinds of sectors that are less likely to slash their CapEx budgets.
That makes sense.
And we saw a key innovation signal, too.
That would be the Skyline launch, right, from Knoll.
Yep. They noted it's already gaining real traction within the A&D community.
And for anyone who doesn't know, A&D means architecture and design firms.
Exactly. These are the people who specify what goes into these massive corporate build-outs, getting them on board before the product even officially accepts orders in January. That's a huge positive signal for the future.
What's maybe even more compelling is the velocity you mentioned, the speed.
That's where you can feel the confidence from management. They said it explicitly.
Yeah.
Customers are making these big CapEx decisions faster now. The hesitation from the COVID era, it's gone.
Right.
Decision velocity is up. And critically, that order flow was consistent across all 3 months of the quarter. This wasn't just one big deal padding the numbers. It's a sustained quickening pace.
Okay, let's shift gears. Let's move from the big B2B contracts and look at the consumer side. Global retail.
Right.
This also saw strong growth, and it's a huge part of their strategy, even if it's causing some headaches right now.
Global retail was surprisingly strong. I mean, orders up 6% year over year, 4.5 organic, sales climbed almost 5%. But the holiday period data, that was remarkable.
Tell me about that holiday boost.
So orders surged 12% across that crucial 12-day window, from Black Friday through Giving Tuesday.
12% is huge.
It's huge. And what's amazing is they did that while keeping their promo and marketing spend basically flat year over year.
Wait, hold on. 12% growth with no extra ad spend.
Exactly. It suggests the demand is real. It's not just discount-driven. People actually want the product.
So what's driving that? Why are consumers opening their wallets?
It ties right into their strategy. Their average order value is rising. And that's driven by two things. First, they've expanded their collection count by 22%, so more premium stuff to sell. And second, they're getting higher penetration from their design services, which, naturally leads to bigger sales.
And they're getting new customers through the door with a rapidly expanding physical footprint.
Yes, and that physical footprint is the main caveat in this otherwise rosy report. We have to talk about the expansion costs.
This is where the short-term pain is centered.
It is the main sticking point, and it's why the timeline is so critical. MillerKnoll is accelerating their plan to basically double the DWR and Herman Miller store count. They're now looking at opening 14 to 16 new stores this fiscal year.
That's up from what they said before. They're moving fast.
Very fast. And aggressive expansion means aggressive costs, especially before those stores actually start turning a profit.
So what kind of pressure did that put on margins in Q2?
Significant pressure. Management detailed that just the cost of building out and staffing these new locations created an incremental operating expense of about $5 to $6 million.
$5 to $6 million, that's cash out the door.
In Q2 alone. And they warned us to expect a similar drag in Q3 and Q4.
So if you're an investor, you're looking at a $15 to $18 million hit over 3 quarters. You need a very precise timeline for when that turns into a profit.
And they gave one. The timeline is tight. They expect these investments to become accretive, meaning they start adding to profit in Q4 of this fiscal year and Q1 of next fiscal year.
So roughly 9 months from now.
Exactly. And that is the single most important execution target they have. If that timeline slips, the whole bullish story on retail starts to unravel pretty quickly.
Which makes the next couple of quarters a real execution test. Speaking of which, let's look at the Q3 guidance. That was also better than expected, right?
It was. The guidance implies that the momentum is continuing. They projected net sales of $923 million to $963 million. At the midpoint, that's like 7.6% year-over-year growth. Pretty robust.
And EPS.
Adjusted EPS is forecasted between 42 and 48 cents.
Are there any headwinds baked into that guide?
Yeah, 2 seasonal things. The usual contract softness you see at the end of the calendar year and then the timing of the Chinese New Year. But, and this is just as important as the order growth, they gave huge reassurance on their ability to manage margins.
Gross margin was healthy at 39% in Q2.
Yeah.
How are they navigating things like tariffs?
Very proactively, and this builds credibility. They cited about $1 million in net tariff costs in Q2. But management was crystal clear. They said they expect their mitigation actions, like price hikes and surcharges, to fully offset the tariff impact for the entire second half of the year.
Wow. So they're taking that risk completely off the table for investors.
They are. That certainty removes a huge cloud.
So on one hand, you have this massive increase in investment spending for retail growth, but on the other, they're aggressively tackling other costs to balance it out.
It's the essential duality of the story. They're investing heavily and cutting costs aggressively elsewhere. They talked about consolidating their facility in Muskegon, Michigan.
What kind of savings does that generate?
It's projected to deliver $10 million in annual run rate savings by fiscal 2028.
Yeah.
So that $10 million in future savings provides a really important counterweight to the immediate $5 to $6 million quarterly retail cost drag. It shows disciplined management.
So we've established the market loved the future picture, right? They prioritized orders over the slight sales dip. Let's put this in context. As we said, MLKN is down over 30% in the last year. Why is the market choosing to ignore that now?
Because the market believes this report marks an inflection point. That big jump after hours suggests investors are finally prioritizing 3 things: the order momentum, the healthy backlog of over $700 million, and the strong forward guide. The past is irrelevant if the core story is finally turning.
So what should we be tracking over the next year?
Well, beyond just hitting the Q3 guidance, the capital allocation is key. Their funding growth, yes, but they have a clear debt paydown target. They want to get net debt to EBITDA down from 2.87 times now to somewhere in the 2.0 to 2.5 range.
Which shows discipline.
It shows they aren't damaging the balance sheet. But the number one thing to watch is that Q1 fiscal 27 retail accretion timeline. Does the investment pay off on schedule? That's the whole ballgame.
Okay, let's talk tactical. This is our segment where we explore a purely educational, outrageous, but plausible trade idea.
Yeah.
And the standard disclaimer: this is strictly for entertainment and education. This is not financial advice.
Absolutely. So the pitch here is a tactical long position.
All right.
It's built specifically around that short-term margin drag turning into a long-term catalyst.
Okay, lay out the thesis on the timing.
So the street is focused right now on that headline drag, right? That 5 to 6 million per quarter in extra OPEX from the new stores. We know that cost is baked into the stock price.
Right.
However, management credibility is high. They've already locked in the tariff offset, which stabilizes gross margins, and organic order growth is a solid 4.5%.
So the perceived weakness is the actual entry point.
Precisely. The idea is to go long MLKN shares or maybe some tactical calls now. You do it anticipating the narrative shift that's going to happen when the company reports Q4.
And what will that Q4 report show?
That report should confirm two things for the market. First, that the tariff mitigation was a total success. And second, that the OPEX drag from retail is declining rapidly or maybe even disappearing as the new stores start to mature, right on schedule for that Q1 27 full accretion.
So you're betting on management's execution. You're saying the current share price, which is still cheap after being down 30%, is the entry point before the market fully prices in the revenue from those new stores.
It's a bet on execution timing. The fundamentals, the return to office, the strong orders, they're accelerating. So the risk reward, I think, favors this entry point. The market is waiting for the cost to disappear. We're buying before that's confirmed.
A compelling argument, but definitely contingent on them hitting those ambitious retail timelines.
Definitely.
So let's recap the core bullish points. Massive strength in forward orders, the validation of the return to office tailwind, and the strategic roadmap of aggressive retail expansion combined with that operational cost consolidation.
And if we look beyond just this quarter, you have to think about the long game. Management mentioned that the conversation around AI and what that might do to office design, it's minimal right now in their customer discussions.
Interesting.
Which raises an important question for you, the listener. If this whole office refresh cycle is being fueled by a traditional RTO wave, how much more room does that cycle really have?
Before what?
Before real productivity gains from AI or new hybrid work models driven by AI start to genuinely dampen the demand for all this physical office space.
A truly provocative thought to consider as we head into 2026. The world of work is changing, and MillerKnoll is trying to ride one trend while preparing for the next.
That's the challenge.
Thank you for joining us on this deep dive into the MLKN earnings. Remember, our discussion is for informational purposes only. Do your own work, and we will catch you on the next deep dive.